In this video, I'm going to discuss financial statements. Remember, a corporation is just a money machine. As the CEO or CFO of the company, my obligation is to make sure I'm maximizing shareholder wealth, that the money machine is working properly, it's producing more money. So to make sure the machine's working well, I need to look at the engine. So think of the financial statements as the engine of the firm. If I'm thinking about investing in the firm, maybe buying bonds or stock, I need to estimate the size, timing, and risk of the cash flows. In order to do that, I need to look inside the money machine and see what's going on. I need to realize exactly what these statements tell me, because there are a lot of judgment calls that management can make. I want to make sure I'm getting the true picture and I'm not being deceived or tricked by what's going on here. I don't necessarily mean that in a bad way, that they're doing something malicious, but I just need to recognize the judgment calls that management is going to have to make. Okay, so let's go through these one step at a time. We'll start with the income statement. I want to make sure you realize what each one of these numbers is telling you. And basically it's revenue minus cost is income. That's simple. Revenue minus cost is income. These statements that I'm showing you are as simple as they can get, really. You can see things slightly more advanced in this, but I want to give you the big picture. I don't want you thinking about too much detail now. You can memorize stuff later, but get the big picture now. So sales is the revenue. Cost of goods sold is the cost of the materials, whatever it takes to make the stuff I'm selling. I have operating expenses, which are going to be paying salaries, paying the electric bill, whatever it happens to have to pay to operate the company. Depreciation is something that's interesting. This can be called non-cash charges. Depreciation is not an actual cash payment that I make. I get to deduct that from my income before I report that income to the government to determine my taxes. Interest expense. Remember, note here that this comes before I pay my taxes. So the interest expense comes from what I'm paying to my bondholders or to the bank. I deduct all that. This EBT is my earnings before tax, and then whatever my tax rate is, I multiply that by my EBT, and that's the total taxes I pay, and that's my net income. But I want you to realize net income is not money in your pocket. This is just an estimate of what it is, primarily because depreciation is not cash, and there are other small details with sales and operating expense we won't worry about now, but remember, net income is not necessarily money straight in your pocket. Okay, next look at the balance sheet. One important thing about a balance sheet is called a balance sheet because it balances. The total assets, that's what you have, is equal to the total liabilities and equity. Total liabilities and equity is what you owe and the value of the firm. So the total assets is equal to the total liabilities and equity. That's always going to be true everywhere, all the time. If I were to mark out any one of these numbers and you didn't know what it was, you could figure it out because you know this column has to equal 47,985, so you can figure out that number. Alright, so let's look at some more details on this. First, we have our current assets. These three, cash, accounts receivable, and inventory, are my current assets. Those are the things that are relatively liquid. I can turn those into cash relatively soon. One thing to point out here, gross fixed assets and accumulated depreciation is not going to be reported all the time. Firms are only required to report net fixed assets, so they only have to give you this number right there. Gross fixed assets is the total cost of the fixed assets that you've bought. Accumulated depreciation is a depreciation that has accumulated over time. Okay, so you will add accumulated depreciation up every year. For example, depreciation expense was $19.54. Last year, this is prior year, last year's accumulated depreciation was $2,000. I add $19.54 to it to get this year's accumulated depreciation. And remember, this balance sheet prior year, this is a snapshot December 31st maybe of 2012. Maybe this is December 31st, 2013, or whatever year you happen to be in. Same thing with the income statement. That's the current year. That's a snapshot. It doesn't tell me everything. It tells me a snapshot of what's going on at that time. So net fixed assets have to be reported. Gross fixed assets and accumulated depreciation do not. So if I add my current assets, which is just these three numbers added up, plus my net fixed assets. That gives me my total assets. Right, on the other side of the balance sheet, we have our current liabilities. Right here, these are the things that I owe in the relatively near future. Then I have my long-term debt, and then I have my equity portion. So these three right here, and let me make this a little bit more clear. Go with a slightly different color here, because this is important. These three, this is my equity portion right there. So common stock can be split into two different things: common stock at par and additional paid in capital. If this par is at 25 cents, the number of shares that I have, number of shares, is equal to 880 divided by 0.25, whatever that number happens to be. That's the number of shares of common stock that I have. And then this is my retained earnings. And that's the balance sheet from the prior year. So really, that's all there is to the income statement and balance sheet as far as getting those numbers out. Now let me show you one other thing here that'll give me good comparisons. I'll show you why this is important. So just give me a second to get some numbers. Okay, here is what's called a common size income statement and balance sheet. So it's the exact same numbers you had before, but I put them in percent. And this is going to be important because what am I trying to do? I'm trying to see, is the corporation a successful money machine? So by looking at this, doing a common size, what I've done for the income statement is I take each one of the numbers of the cost of goods sold, the gross profit, all these numbers, and divide by total sales. So from the total sales number that you had before, for example, what we had before was this: we had total sales of 46542, and our cost of goods sold was 18,216. So that shows me that the percentage of cost of goods sold as a percent of sales was 39.14%. This is going to be helpful because I can look percentage wise and see, are my operating expenses going up as a percent? Because think, if sales go up, cost of goods sold goes up, operating expenses go up, all these things should go up. But am I controlling my expenses? Am I letting them proportionately go up too much? Same thing over here for cash. I can look and say my total cash last time was 14,035. My total assets were 47,985. So my cash was 29.2% of my total assets. So I can look at this and say, is my accounts receivable going up too much, my inventory? Because I'm growing as a firm, and I hope this number of total assets and this number of total sales, I hope those numbers increase. But does my debt go up too much? Are my accounts payable too high? I can look at all those numbers. I can compare one firm with the other. I can compare Coke and Pepsi. I can compare Caspian Sea Drinks with itself from a few years ago. So from this, the two takeaways for the income statement and balance sheet. Income statement tells me how much money I'm generating, but it's not exactly money. That net income is not exactly the exact number of dollars that I need. The balance sheet tells me how much I have and how much I owe and how much my firm is worth. It would be nice if I could put those in percentage terms, so I do that with a common size income statement and balance sheet. One last thing, and we're spending entire videos on those, so I might just talk about this very briefly. Statement of cash flows. So statement of cash flows from the income statement and balance sheet, I want to know how cash changed. So for example, let me go back to the actual dollar amounts here. Okay, looking at these actual dollar amounts, I want to think about my statement of cash flows and say, you know what, last year I had 11,337 in cash. This year I had 14,035 in cash. Where did that cash come from? How come it increased? There are three places it can come from. It can come from operations, it can come from investing, and it can come from financing. So I want to make sure that those cash flows are being generated from the right place, and that's operations. I want to think about why that is and how it works. And we'll talk about how to do those statement of cash flows later. But importantly, what are financial statements and why are they important? Income statement, balance sheet, statement of cash flows. Why they're important? It allows me to see, is the money machine working as a money machine? And it's just going to take you some time to go through and write these over and over again so you can take the component parts and build these statements. It's not you listening to somebody talking on a video or live. You're just going to have to spend time actually doing that. So, good luck.